So before I get into the concept of infinite banking and how it works, I want to make it clear that I'm not selling you any life insurance policies, nor am I an insurance broker. And to be completely transparent up front, I do not have a whole life insurance policy for me or my family. I did the whole math on this and didn't find any mathematical sense for my financial situation. I'm going to share the research and what I found throughout this video. Now, could it be right for you? You should only be the one to answer that question. The purpose of me making this video is to make sure that you understand how whole life insurance really works. You should not blindly listen to what your insurance agents are saying on TikTok or other social media sites. I have seen videos of people saying how the 401k or Roth IRA is a scam, and the comparison between your retirement vehicles like 401k, Roth IRA, and HSA with life insurance policies simply doesn't make any sense. As a financial coach, I would never tell you or my clients not to get whole life insurance policies because what doesn't work for me might work for you. So get a pen and paper ready because I am super fired up to talk about this juicy subject.
Probably need to take some notes.
The term infinite banking means that you, as a whole life insurance policyholder, take out a loan or a personal line of credit against the cash value component that grows at a rate of return over time inside a whole life insurance policy. So let me back up a little bit and explain a little bit further. You are the whole life insurance policyholder. And as the name suggests, a whole life insurance policy can cover you for your entire life. Unlike the term life insurance, it doesn't come with a set of period of time like 10, 20, or 30 years. And when I got quoted for my whole life insurance policy several years ago, it was going to be about $500 a month, and the premium payments would never go up. So I will use that as an example here. And let's say the policy was for $500,000, but in terms of how much you contribute to your life insurance policy, the whole life insurance premium is 10 to 15 times more expensive than term life insurance because it covers your entire life and comes with a savings component, also known as the cash value. So a certain percentage of your fixed annual premium goes to the policy itself, while the other portion goes to the cash value of your life insurance policy. But here's the kicker about the premiums and why the insurance agents will try to sell you this product. The premium you pay in the first year is actually going to the commission, and it's typically between 60 and 80% of the premiums. In the subsequent years, they still charge you anywhere between 5 and 10% in commission for all the premiums you pay over the life of the policy. Not to mention the administrative fees they charge you to maintain the whole life policy. So $500 per month multiplied by 12 months is $6,000, right? So in the first year, the insurance agent could receive up to $4,800 in commission, while the rest of it goes to your death benefit. Starting in the second year, that could be $300 to $600 per year that goes to their commission. Now, if you're really looking to buy whole life insurance, you need to ask the agent about the commission they'll receive, and they're probably going to be hesitant to tell you for a number of obvious reasons. If your whole life insurance premium is higher, then their commission in the first year is going to be higher as well, right? You can always look into fee-based insurance agents, but it's going to be very hard to find those because they make more money if they work commission-based. And this was one of the main reasons why I chose term life insurance, because when I asked about the commission, they were going to take 70% of the premium in my first year of the policy towards the commission. There are different payment types for the whole life insurance policy, and the quote I got was a fixed amount of around $500 per month for the rest of my life. But what they offered me was their standard fixed payments to the cash value of my policy. So I would just make the monthly payments with both death benefits and cash value. They're also going to give you the option to do what's called a single premium if you wish to pay the entire cost of the policy up front and give you the cash value right away with no more premiums to pay. And that's if you have the money to do it. And most people don't have the money to pay the premiums up front. So something else that was offered to me was what's called a limited payment for the first 10 to 20 years to pay the death benefit and then contribute the rest to the cash value. And there are many other payment methods I didn't cover here, but you need to research how your premiums are contributed to your whole life policy before getting one. And remember this, when you think about the whole life insurance policy, the premiums you pay into your policy will go towards the death benefit, commission, and fees towards the insurance company and the cash value. You also don't get to dictate how much of your monthly payments go into the cash value. So in the first 10 years or so, the majority of the premium will go into the death benefit, while a smaller percentage goes into the cash value. As time passes by, more premiums will be put into the cash value account. And in most cases, you're not going to see the cash value portion grow until 5 years have passed, but that cash value will grow tax deferred for the simple reason because according to the IRS, dividends from whole life insurance policy are actually a refund for overpaid premiums, which is another weird concept. And let me use my example, okay? And I pay $500 a month in premiums. And let's say the dividend yield is 5% in the cash value. That 5% actually comes from my own death benefit policy that I paid into, so that cash value grows over time. The higher the dividend, the more expensive the policy will be. So the 5% dividend is what I paid into the policy already. Cash dividends are not taxable as long as they don't exceed the total premium I paid into the policy. This is something you never hear from the life insurance company unless you ask about it. So if I paid $100,000 into my premium so far, the cash value of $100,000 or less is not taxable. Anything above that is considered taxable income. That makes sense so far. And here's another component to the cash value, and that's the interest accruement. And you have to remember that interest is not the same as dividends. We don't have any control over how the life insurance company invests the cash value, but it's typically saved in a conservative yield investment. Some insurance policies are managed by publicly traded companies and rely on their dividend payouts to increase the cash value. But you also have to remember that company dividend payouts are never guaranteed, no matter how long they've been distributing dividends. Walgreens and AT&T are the two companies I can think of right now that recently slashed their dividends after many decades, but they don't advertise that you only get an average of 2% return after commission and fees every year. So when I see TikTok or YouTube shorts about how you could earn 5% in annual dividend yield, it's actually an average of 2% annual growth, which is barely beating our current inflation rate. And when I personally applied for the whole life insurance policy, they told me the estimated cash value I would have is about $300,000 after 30 years. And I did my own math using that 5% annual dividend yield, and it was far below the value I calculated using the compound interest calculator. And you can use your own financial resources like my compound interest calculator on the spreadsheet for absolutely free by visiting firestitcher.com/resources. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. Even after I paid the majority of my death benefits for the first 10 years, the numbers did not add up with a 5% annual rate of return. Assuming that I would pay $500 a month for the next 30 years, the total contribution value to my premiums would be $180,000. And even if I contribute 50% of my premiums to the cash value over the next 30 years, that's only $204,000. Because what they didn't mention was in this small paragraph at the bottom of the life insurance agreement that I would pay a certain percentage of the fees and commission before it goes to my cash value. And that was one of my deciding factors as to why I didn't get a whole life insurance policy. And I could just use that money and invest in an index fund that charges me less than 0.07% annually. And the second factor was the most mind-blowing of all, which is what actually happens to the cash value when I die. And let's say that my whole life insurance policy is $500,000 by using the same example. The cash value of $300,000 actually goes back to the life insurance company, and my beneficiary will only get $200,000 out of the whole policy. It doesn't make any sense that the life insurance company should get that cash value. So all the money you put into the cash value will just end up benefiting the life insurance company, even if you leave that money intact. And that was the primary reason why I did not go with whole life insurance policy. And cash value loan, let's talk about that for a second. So, how do I gain access to the cash value of my whole life insurance? And there are generally four ways to do it. First, you can simply withdraw money from your cash value without paying any taxes on it, as long as the amount withdrawn doesn't exceed the amount you've paid in premiums thus far. And I can use that cash value to pay for my insurance premiums instead. Using that same example of $500 per month, I can just use the cash value to pay the premiums. And if the insurance company allows it, I could trade my cash value for a higher death benefit to leave more money to my beneficiaries. And that could prevent your life insurance policy or life insurance company to take away that cash value upon your death. And third, I could surrender my policy. It means that I'm canceling my whole life insurance policy and getting paid a cash value. However, the surrender fee could start at 10% of the cash value if I'm only 1 year into my whole life insurance policy. So basically, you have a contract with the life insurance for 10 years so that you don't get charged for that surrender fee. The surrender fee does go down to 1% after year 9, and then there are no surrender fees after 10 years, depending on the policy. And some policies do make you stay with them for 15 years or maybe even more. Also keep in mind that the cash surrender value of life insurance is taxable if the amount surrendered is more than the premium paid, and you're not going to be taxed for the whole thing, but you could get taxed on the investment gains. And fourth, and I could borrow against the cash value. Let me do a deep dive on this. And let's say I've held my whole life insurance policy for at least 10 years, which is the typical length of time it takes to have enough to borrow against. The limit to borrow against a life insurance policy is usually no more than 90% of the policy's cash value. And most people receive about 20% of the face value on average of the life insurance policy. So for my $500,000 life insurance policy, the policy's cash value would be around $100,000. And if I want to take out a loan, I would be allowed to take out 90% of the $100,000 cash value, or $90,000 total. And the insurance company will use your cash value as collateral. And I know $100,000 might be a little bit too much at the 10-year mark, but I'm just going to use it as an example to explain it as simply as possible. Now, the benefit of taking out a loan against your cash value is that you don't have to repay it. And I know that's so weird to hear it, but you're essentially borrowing money with your own money. That's why they call it infinite banking. However, there are some significant downsides to not repaying the loan, and I promise I will get to that in a little bit. And let's say I decide to take a loan against my cash value. When they say it's a tax-free funding source, that is a correct statement because the IRS does not recognize policy loans as income. And it doesn't affect your credit score because you're technically taking out a loan with your own money. But how the interest is charged will depend on the life insurance policy. So the interest charged to your loan will go back to the insurance company, and it could be a fixed or variable interest rate. It depends on your policy. The first option you have is to make periodic repayments of both principal and interest payments, just like repaying any personal loans, right? You should also keep in mind that there's direct recognition, which defines how much interest is credited to the amount of the cash value that is loaned out. If your insurance company says they only do the non-direct recognition method, then you're going to receive the same dividend on all of your cash value. And I could really nerd out on this, but I'll explain it in more of a general sense. They're also going to give you a second option to deduct interest directly from the cash value. So the interest charged by your insurance company could come directly from the cash value you have in your whole life insurance policy. That's another definition of infinite banking because you're repaying the loan interest with your own cash value. And the third option is to make interest-only payments. So if you take $90,000 with a 7% fixed interest rate, you will have to repay $6,300 a year or $525 per month in interest-only repayments. You'll have to pay that as long as you have a balance on it. They also allow you to spread out the interest payments on your own terms because life insurance loans don't typically have a timeline for repayment. And that could be dangerous too, and I'll explain why. Because here's the question I had for my life insurance agent at the time when I did this research. Say that I never pay back my loan. What happens to my death benefit? Well, if the loan is not paid back before I die, the insurance company will pay that borrowed amount from my death benefit. And let's say that's $500,000. So with the added interest and fees, my death benefit could be reduced significantly. That means my beneficiary would get much less than what the policy originally had. So if I never pay back the loan for a number of years and the interest keeps going up and I end up owing more than what I have in my policy, it will eventually lapse. If the policy lapses, the IRS will treat the cash I took out as taxable income. Again, if the policy lapses, my beneficiaries will lose their inheritance from my life insurance policy, and I would also lose the opportunity to use that money again in the future. On top of that, I would have to pay federal and state income taxes for lapsing the policy. And after doing extensive research on my own, I decided to get term life insurance for 20 years instead. And I've been paying $40 a month for my term life insurance for the last 5 years or so, okay? And my term life insurance doesn't come with cash value like whole life insurance, and that was fine with me because I used that money to invest in my retirement vehicles like 401k, Roth IRA, and HSA for much cheaper. And I've also been investing in my own dividend-paying portfolio in my taxable brokerage account that pays me dividends every quarter, almost every month now with all the stocks that I have. And look, the purpose of this video is not to beat down whole life insurance, but to actually look deeper than what they're saying on the surface. You have to remember that if something sounds too good to be true, then it probably is. I'm also not going to tell you that whole life insurance may not be right for you. It wasn't right for me because, for one, the math didn't add up. And two, I didn't like the fact that if I die with a policy, the insurance company takes back the cash value. That's my money. That didn't make sense to me whatsoever. And three, the premiums were way too high, even if it's for my whole life. I shouldn't need life insurance to cover my beneficiary's income or assets for the rest of my life because I'm going to have enough assets in 20 years that will make life insurance irrelevant. Now, I don't have any personal vendetta against life insurance agents because they're just doing their jobs and selling their products, right? And what I'm absolutely against is how some people on social media are spreading misinformation about the 401k and Roth IRA and how they're supposedly scams. And that whole life insurance is the only way to go. If you're going to advertise whole life insurance, you should talk about everything that I just went over. Let me know in the comment section down below if you have any experience with whole life insurance.